Welcome all to the session of corporate finance. So in this video, we are going to discuss about concepts in equity and debt. Let us start with equity share. What is that word equity? As the word itself implies, every person who is going to hold this specific instrument is going to be considered equitable. When it comes to responsibility or when it comes to the benefit, a person is going to be equitable. That's the reason this specific instrument got its name called as equity share. So the shares that is traded in the market is generally equity share. This is called as a common share. So this equity share, that common share, why it is called is it has one vote for every share. So we will discuss that possibly in the features of an equity share. The first feature of an equity share is maturity period. If you are going to deposit a money, let's say a fixed deposit in a bank, it's specified, it's a contract that 4 years it will expire or 5 years it will expire. After that expiry, you will get that principal amount. Meanwhile, you will also get the interest components. But here, in this equity share, there is no maturity period, which means you buy that share price will increase in the market. You can pass on to the share after your lifetime to your son or daughter, and they can pass it on possibly to your grandson or granddaughters. So like that, an equity share is highly negotiable. It can be passed on to several generations or it can be sold to others. It doesn't have a maturity period. So which means the principal money is not going to return to you. You can just sell it in the secondary market and you can take back your money if the company is listed. And the second feature is shareholders' voting rights. Now, the equity shareholder of a company is owner of a company. So even I can become a owner of a company. So possibly when I buy share from a company, as a retail investor, I may be having 0.0001% of a company. So, but still, I should be considered as a owner of a company. So, the equity shareholders are owners of a company. So, they will have voting rights. When a director has to be appointed, there will be voting right. When a company is going for an organic or inorganic expansions, there will be a voting right. So, for a common share, for a one share, you will have one vote. If you have 100 shares, 100 vote. But there is a different kind of equity share which is called as differential voting right shares. In some countries, it is called as dual class shares. Here, the voting rights may differ. For example, if you have 10 shares, you will be provided with one vote. Or if you have 100 shares, you will be provided with one vote. Why there is restriction here in the voting rights? So here, when it comes to equity share, possibly non-promoters and other people are going to enter into a company. So in future, if they are going to acquire more and more of shares, they can even enter into board of a company. So by that, a control of the promoter may be lost. So that's a reason to protect that company. So sometimes a company has a different kind of equity share, which is generally called differential voting rights or dual class shares. The next biggest feature of an equity share is income from equity share. These people get the last claim. It's called as residual. After giving interest to the debenture holders or to the creditors, after giving dividend for the preference shareholders, whatever has been left, some part may be diverted as retained earnings or reserves and some part can be provided as dividend. So here there is nothing like a fixed income available from the equity shares. It may differ year on year. Some year you may get income, some year you may not get income by the way of dividends. So this is a residual claim. Okay, and the fourth point is a claim on the company's assets. So when the company is about to liquidate, they want to close the company. In such a case, they first settle the creditors, then the preference shareholders, and whatever has been left will go to the equity shareholders. Similar to the income, Even the claim of the company's assets also, the last people would be the equity shareholders. And the last biggest feature of equity share is limited liability. What is that limited liability? A equity shareholder liability is limited only up to the payment that is not being made. Let's say, for example, face value of a share is rupees 10. The company has called up a face value of only 8 rupees, and the company says that we will collect the 2 rupees in the future. When the company is about to close, now the liability of a shareholder is only 2 rupees they have to return to that company. Right? So this is related to limited liability. Only that unpaid amount to that company has to be paid by the equity shareholders. Here comes the advantages of equity investments. As a equity shareholder, when a company share is listed in the stock market, every day there will be fluctuations. The company's price increases, decreases. So there is a possibility that you can make a very big return. As a corporate, you can invest in other corporate. As an individual, you can invest in other stocks. In any way, if you're going to invest in equity, possibly if the company is fundamentally good, you can make a very high return. Let us recollect some example related to this. TVS Motors traded at 100 rupees should be a decade back. Now the company possibly trades beyond 1500. You can see that appreciation. Nearly 15 times of return. I'm not speaking in terms of percentage. It's 15 times the company has grown. It's a multi-bagger. And this has happened because of many strategies the company has taken. Their tie-up possibly in product developments, markets and other related things resulted in such a very good scope for that company and in turn towards the higher returns. Then it is a cushion against that inflation. We know that inflation of India hovers from 5 to 6%. If you're going to park our money in instruments like possibly savings account or maybe fixed deposits, it can hardly fetch you 6%. But equity, if we carefully plan, possibly it can give 10-15%. Sometimes it can be very, very high. It can be a multi-bagger. So, as to recollect an example, okay, the equity or else the investment that has been made by Tata Motors in the Jaguar and Land Rover, it has resulted possibly in something very big for that company. The company's share, which was selling at even 60 or 70, near 100 at one point of time, you can see it's unimaginable now, trading around 1000 rupees, possibly 10 times higher. So, equity as an investment is advantageous for both the corporates and also for the individuals, and it's a very big cushion against that inflation. Then it is ease of investment. It's very easy. With a demat account, we can go and purchase an equity share of a company. And diversification, it's something very, very important. Okay, if you want to diversify the risk in the market, so you have to go and invest in any kind of equity investments. Then we can move on to the disadvantages possibly of equity shares. There is a very high market risk. I said that a share price may go up from 100 to 1500. The same thing may happen, a share may come down from 100 to even, let's say, 10 or even 20. Let us take an example of a corporate case related to Anil Ambani. So there was a company called as Reliance Power, which had a very big impact when it came into the market. So the stock traded 250, 300. Suddenly, you know what happened to that Anil Ambani's group. So possibly the company has completely lost that market value and nobody is now interested towards in that company. And then it's a performance related risk. The same example can be taken. The Reliance Infrastructure Industries, it is related to many infrastructure projects that is related to finance. Most of the projects they have taken has not made a better performance, and because of that specific risk of that company's project has not performed, the shares got valued very, very less now, and people are said again not interested. Next biggest risk in equity is again here also it is inflation. If everything goes positive and if you grow by 15-20% every year, it's something very good. But what if happens if you are growing less than inflation? Inflation grows by 5% and if your company grows by only 2% or 3%, what would happen to your investment? And then it is a liquidity related risk. There are certain businesses where there will be a very big gestation period and the money will be getting locked. Examples are the projects related to infrastructure, power, construction. Okay, all these companies have very high liquidity kind of risk because the entire money get locked in few projects and only after the completion of projects, right, the revenue stream starts. So this equity investment has this disadvantage. When you choose a company, you should be very careful whether the company has liquidity. And then when it comes to the social or maybe the political risk associated with equity investments, your equity valuation can even become zero because of certain political risk. So what if in a case like what happened in Venezuela or the other countries where suddenly a government may say that the entire company is going to be confiscated by the government or maybe expropriated by the government. So all these things may happen. So suddenly the company's valuation would fall. So there are plenty of examples that is related to political risk happening all around the world. Next, we can move on into a concept called as debentures. Debenture is actually a creditorship related instrument. It is like keeping a money in a fixed deposit earning a regular return. You know, the fixed deposit return is regular and it will not grow. If it is 7%, every quarter or every year you will have only 7%, it will not grow. And fine, one day what will happen, there will be going to be a maturity. And in that maturity, your principal amount is going to be returned. So, debenture is a creditorship related instrument. So, these are all the features of debentures. The first one is a written promise. Here, the written promise is your money will be paid back. Okay, and then the second one is it has a maturity. What is that maturity? So, the company will pay back the principal amount in 5 years or in 10 years. So, it has a maturity date. And then the third one is return in interest. So, for an equity share, return is by the way of dividend. By the way of debentures, that is a creditorship related instrument, the return is going to be in interest. And this is fixed. If it is 7%, you will get only 7% of interest for the 5 years or 6 years of agreed period. So, it is not going to change. And the fourth one is it's an assured payment. Even though it is 7% or 6%, it is not going to grow. It's an assured payment. You will get that in an agreed, the promised deadline. Whether it is going to be monthly, quarterly, half-yearly or yearly, there is going to be an assured payment of interest and also assured payment of your principal. And here, the debenture holders are generally creditors to the company. Right. Next, here comes the types of debentures. Debentures may be classified by the way of security, tenure, convertibility, coupon based, registration based, or maybe by the way of redemptions. So, what is secured and unsecured? It is like a loan that you are going to take, whether it is going to be with collateral or without collateral. With collateral, a banker would be happy. Without collateral, a banker may not be happy because there is a possibility of more default when it comes to an uncollateral kind of thing. Here, the security based debenture means, right, the company would say that so possibly this is the kind of assets they have and based on the assets backup, this is going to be released. So, it can be a secured or it can be an unsecured kind of debt. Okay, when it is secured, obviously you are going to get possibly a less interest. When it is an unsecured one, the interest rate is going to be comparatively higher because there is more default risk associated with unsecured kind of risk. Then based on the tenure, it can be redeemable or irredeemable. There is one concept, specified maturity, right? If there is a maturity date provided, it is called as redeemable. If there is no maturity date, it is irredeemable. This irredeemable concept means there is no maturity date. So there is one exception here, that one specific instrument is an exception to the feature of debentures. Then based on the conversion, it can be partial, fully, optionally or non-convertible. Non-convertible means until the maturity or even after that maturity, when the company is going to buy it back, it cannot be converted into other kind of security. Optionally convertible means so that specific debenture can be converted into an equity share or a preference share, but that option is provided to the person who is holding. Fully convertible means the complete percentage of debenture you are holding can be converted into either equity or else maybe as a preference in the future. Partly convertible means a 25% of your debenture or a 50% of debenture as agreed in the contract can be converted into equity or as a preference share in the future. Then based on the coupon rate, specific coupon means as a fixed percentage will be specified, 8% of interest rate every year. So that is a specific coupon thing. Zero coupon is there is no interest rate or interest provided for this specific kind of security or maybe a debenture. What here happens is when a company releases the debenture, let's say 1,000 rupees debenture or a bond, the company will say that we will issue this bond for 800 rupees and we will redeem it for 1,000 rupees. Understand? They are selling you for 800 rupees and they are going to buy it back for 1,000 rupees maybe after 5 years or 10 years. Here there is no interest provided, but still you can see the big variation between 800 and 1,000. That 200 rupees is going to be the money you can make out of this instrument. So that's the reason it is called as zero coupon. They are not going to pay you interest. Instead, there is going to be a very big gap between the selling price and the buying price. Then registration based. Usually the debentures will get registered under your name. Only then after 5 years or 10 years of agreed time, the company can buy it back and they can give you the principal amount, and meanwhile also the interest can be credited back to your account. And there is another thing called as a bearer kind of registration available. So here, similar to the share, the bond can be negotiated to another person. That another person will become the owner and possibly the person will reap away the benefits. So like the share, the bonds can also be traded. So the Indian market is not much developed for this instrument, but in a market like USA, even the bonds can be traded and the bearer will receive the interest rate and also the possible buyback money. Then it is redemption based. Here it can be a callable, puttable, subordinate or participating kind of thing. So when it comes to a callable kind of debenture, so even earlier a company can call back, right, before that agreed term, that is 10 years or 5 years, a company can have an option that they can buy back the instrument and they can pay. That opposite sense is called as puttable. It starts from the investor's end. Then subordinate is something like the redemption is going to happen possibly at a discounted or a lesser rate, right, subordinated. Then participating, as a debenture holder, sometimes you can be allowed to even participate in the board, or sometimes you may be allowed to participate in the decision that is going to be taken by the company and other related things. So there is a benefit of small attachment from the equity shareholders feature. So that is a participating kind of thing. And here also in this redemption, there is one more variation you can say. When the company want to buy even before that specified time, either you can participate and sell, or else you can hold it and keep it until the maturity date and then also you can sell. So there is different variation when it comes to the participation kind of debentures. And in this video we had discussions that is related to equity and debentures. Let us have further discussion with a stream of videos. Thank you.